All right. Hey, everybody. We are here today with Pierre Ferragu of New Street Research, analyst that covers Tesla. I believe you have an $800 price target on the stock right now. Previously, one of the highest on the street, maybe the highest at a point in time. But with the recent updates from all the analysts after Q4 earnings, I think some people have taken it up and you're more in the neutral-ish range now.
Yeah,
so welcome, Pierre. Thanks for coming on the podcast. Appreciate it.
Thanks, Rob. Thanks for having me. I'm very humbled to be part of your podcast. You have way more followers on Twitter than I do, so it's a very new world to me. I focus more, as you know, as an analyst on institutional investors, and one of the things I've really enjoyed with Tesla is getting more exposure to retail investors. And when I look at the wealth of debate and conversations and work that is done in that group, I'm very interested, and I hope I can do more of that going forward. And yes, on our background on Tesla, so I left Bernstein, one of the leading research houses on Wall Street a couple of years ago, to start my own firm to do really research in a new way. And one of the things we did at the time is to pick up coverage of Tesla. And I actually started working with a fairly negative bias on the story. I didn't think really things could stack up, like this idea that you just put like a battery pack in a car, an electrical motor, and then suddenly you're worth $50 billion. But I did the work, and we teared down a car and looked at what was in it. And my team and I had a very strong background in the semiconductor industry, we were able to actually check, what Tesla was able to do against others, and we came to the conclusion that they would not have competition for a very long time. And then the second thing we did is that we looked at the potential demand for these electric cars and what the potential economic model would be, and then we suddenly realized that the vast majority of professional analysts looking at the name were just gave a pass on the work and didn't look at it, and were missing very obvious fundamentals of the business model. So at the time, it was in April 2018, we initiated coverage with a $530 price target, which I think at the time was the highest price target, and we didn't try to make any sensational news out of it. It's just reflected our common sense work on the name. And you see a couple of years down the line, increasing a $530 price target to $800 basically reflects like a 20% per annum kind of appreciation in the stock price, which reflects a couple of years, and also a lot of things that were still uncertain and bets a couple of years ago that are clearer and more certain today. So actually, over the last 2 years, Tesla is probably the company on which we have the least changed our opinion. We still look at it the way we were looking at it a couple of years ago, and we just have a bit more visibility on a few things.
Right. And that's something that I think is important to understand. Price targets in general is, I think in your guys' research, you have sort of a range for 2026 timeframe between, was it like $1,200 to $1,700 or something like that? And then that's just discounted back at about 15% per year for, accounts for risk and things like that.
Yeah, I think it's an important element to keep in mind, because I've had a lot of questions from the retail crowd on the recent downgrade, when we said, we downgrade the stock with a neutral rating. So when we set a price target, it's not like what the company is going to be worth ultimately. It's what we think the stock can be worth in a year from now. So in that, you take into account the fundamental aspect of the story, which is exactly what you described. Okay, in 5 years from now, what's a reasonable outcome? And for Tesla, the range of potential outcome is fairly wide, because you can go from just being a reasonably successful car company to being a very successful car company with leading margins and structurally gaining share against traditional competition. And you can actually go beyond that and say it could be like a self-insured car company where every single Tesla is actually insured by Tesla. You could say it's also doing as much money in energy storage and in cars. And you could even say It's going to manage like a fleet of driverless robotaxis. And of course, if you take that whole range, the right price target in 5 years from now is difficult to estimate. But then, so we have our perspective and on what is achievable over 5 years and what will be visible over 5 years. Then we need to discount that back to today. So if I'm telling you the stock is going to be worth between $1,100 and $1,700 in 5 years from now, I'm not going to tell you buy it today at $1,700, right? Because that would be like a bad investment. So
right.
I want you to make at least 15%. And if I think it's a volatile and risky stock, I might want you to make 20% a year on that one. So the way we look at it today is that if you own Tesla at $800 today, you're going to be worth between $1,100 and $1,700 in 4 years from now. That's an okay range of return. If the stock is at $1,000, it becomes like probably slightly too expensive. Then the third aspect that gets into the way we think about a price target is what's going to happen in the next year. Like for instance, if I knew with a high level of conviction, if I believed with a high level of conviction, Tesla would be on the higher end of the range, $1,700, then my price target today should be $1,000. What do I need to believe for like my 5 years view to be more on the 1,700 side? I need to have convictions on how high Tesla can go in terms of gross margin on the car business. I need to know how fast Tesla can ramp the energy storage business. And I need to know how big the autopilot feature is going to boost gross margins. And I don't think I'm going to learn that much about that in the next 12 months. So I can't really push, in the next 12 months my range higher. My view could change if tomorrow Tesla releases a new beta version of the autopilot that is a complete game changer. You would see, of course, our perspective adjusting to that relatively rapidly, but we don't really believe in that. And then we look at it on the upside and on the downside. And for this year, on the downside, we thought like professional, like the investment institutional analyst community is not modeling right probably the gross margin for the first quarter. So that's a risk, because when even if the company does well, if it doesn't meet expectations, it's kind of weird, but the stock is punished for that. Then you have like the ramp of a new factory in Germany. We saw that as a factor of risk, because Germany is a complicated country. You have like courts everywhere that can make ruling against you very easily. And we've seen very recently that like the news flow coming from Germany might be negative. They will eventually have, of course, a factory up and running in Germany, but I think it's probably not going to be as smooth a sail as it was in Shanghai.
Yeah, it's tough to compete with that for sure.
Exactly. And then there is another element that makes us slightly nervous about the stock for this year is the introduction of the Model Y. And here, that's a conversation I've tried to have with the company and with Elon Musk. And they are very confident, and I understand why, because like demand for the Model Y will largely outstrip demand for the Model 3. But I think in the short term, there will be an impact, because today, more than 20% of people who trade in a car for a Model 3 trade in an SUV. I think these people, if the Model Y were available, they would pick the Model Y. And in addition to that, there are people like me who drive a Model 3 today and who will swap it for a Model Y as soon as the Model Y is available. I have 5 kids, and I don't fit them in my Model 3. Right. And so there are people who can't fit their surfing boards and stuff like that in their Model 3. And so I think in the short term, there will be ground for concerns about cannibalization between the Model Y and the Model 3, and maybe the Model Y and the Model X as well. So for this year, there are also reasons for the stock at some point to take a breather, to pull back, to consolidate. And so when I say we have like an $800 price target and we're neutral on the stock, it means this year, if you add to your position, if you buy that stock below $800, you're safe. And of course, the cheaper the better. But that's the idea. So no change at all in the longer term perspective.
Right, that makes sense. So I have a couple of questions on that. Let's first maybe start with what are the assumptions that kind of go into that, $1,100 to $1,700 range for 2026, is it? Mm-hmm. So what are you guys' estimates that are leading to that price target, and then how much of those other factors in terms of like the energy business, the autonomy business, how much of that is factored into sort of that range?
Yeah, okay. So maybe let me take a step back and tell you what are like our three fundamental convictions on Tesla, and then we'll look at how we put that into numbers.
Sure.
Conviction number one, they do cars nobody else can do, and they will maintain that level of like absolute differentiation for the next 5 years. So we don't have to worry about competition or anything like that. Today's cars are about 40% better than the first Model S in terms of range and performance, and the rest of the industry is still at best at the level of the first Model S. And learning how to get like a more efficient battery pack, a more efficient inverter, these things take time to learn and requires you to be very integrated. You don't improve an inverter, you improve how an inverter works with a battery pack and works with a motor. So all these things are going to be very difficult for like traditional auto manufacturers. So that's conviction number one, unique product. Conviction number two, demand for the product is very large, and that's just based on looking at the impact of the Model 3 on its addressable market today, on its addressed market today, so which is roughly the US sedan mid-range market. Model 3 doubled the size of the market, took more than half that market, and 60% of people buying a Model 3 are not in the premium market. So they are trading up to a premium car. When you engineer that to the global car market, that tells you the addressable market for Tesla is 20 million units a year. And I don't even count the Cybertruck in that. So it's more than 20 million units a year.
And that's before they sort of go further down market from where they're at today?
Yes, exactly. It's only premium. And that's, let's say if they do like a mini premium, that would probably still fit within that 20 millions. But if they start to doing like mainstream cars, then that would be, like maybe 3 times more. And by the way, I think Tesla probably is going to be kept busy doing premium cars for the next 10 years. But if you listen carefully to what Elon Musk says, he has like broader ambitions. So who knows?
Definitely.
So that's conviction number two. And then conviction number three is, despite like the very early stage of development of the manufacturing footprint and the go-to-market footprint of Tesla, they are already at industry-leading gross margins. So they can actually sell these cars that are completely unique in a very profitable way. So it's not only a question of nobody else can do that kind of car, it's nobody else can do that kind of car, but I can sell them at a price that creates that monster demand, and I can make money out of it. And by the way, I make enough money to finance my expansion. Okay, so that's the 3 convictions: unique product, pent-up demand, profitable business model. Now, if you put that into music and look at how it's going to happen over the next 5 years, what's the limiting factor? That's actually how many cars you're going to be able to manufacture and how many cars you're going to be able to deliver into the market. So it's actually just execution. We don't need to talk about strategy anymore, or a relative competitive advantage or competitive dynamics. We're done with that. And then what we did is we looked at the pace at which Tesla can add battery manufacturing capacity, car manufacturing capacity, and then we came to the conclusion that in 2025 they should have at least a 2 million units production capacity, and they could have more. Okay, so that's 10% of their addressable market. So you take 9 of these individuals that are in my addressable market, and you forget about them because they can't organize something to have their car charged at home, They go once a year to visit their mother-in-law 600 miles away, and they don't want to stop at a supercharger. 90% is a lot of room for people who are not going to want to play with a Tesla, and the remaining 10% buy one and you're done. And if it's 15%, it's like 3 million. So it's even more than that. So I think a reasonable expectation beyond 2025 is to say Tesla will be delivering between 2 and 3 million units. So 2 and 3 million units, $45,000 ASP, we are still in the premium market, 25% gross margins, which is where they're heading today. Like if you look at the roughly 20% gross margin they do today, if you add to that experience, scale, and an SUV form factor, without making any bets about the adoption of autopilot, it's a 25% gross margin business already. And then you add to that a kind of very, very reasonable contribution from like the energy storage business. So we make it a $20 to $30 billion business by that time versus like a $100 to $150 billion car business. So it's still 10-15% of the total business.
Right. Which would be growing faster than automotive then at that point, because I think it's like 6% or something like that now.
Exactly. So growing faster but not taking off massively. Because I think it's difficult to bet on that kind of time horizon. It will probably come after. And so that gives you a range in terms of and maybe in the last element is that you, with a 25% gross margin, then you have an operating model where you sell your cars over the internet. You don't have to subsidize with car sales like a network of dealers and things like that, and you don't have to fight with marketing dollars against competition because you don't have competition, which means that of this 25% of gross margin, actually, probably 15% of that, 15 points of that is going to flow through to the EBIT line, which means that gives you a range of $15 to $25 billion EBIT. And if you assume that by then Tesla will be trading on like a reasonable multiple for an industry winner with a very strong track record of gaining share, with continuing share gain momentum, of course, we've decided to settle for 15 times EBIT. We could have said 15 to 20 times EBIT, but with 15 times EBIT, which is conservative, that's how we get to this $1,100 to $1,700 price target for like maybe at the beginning of 2024. This is what would make sense. So that's how we see. And once again, the number of upside scenarios to that I would say base forecast, there is a long list, and there is more upside than downside. So we still have a very strong positive bias on how things develop. Things I find the most compelling and the most tangible are the insurance business. So if Tesla ends up having an edge insuring their cars, which they should, because it
seems likely.
It's very, very, very easy for them to go to market. They know the drivers. Very easy for them to have an edge based on data. And I do believe Teslas will be way safer than any other car. So it's difficult to believe it's not going to have like a huge impact on their ability to insure their cars. That is a very significant upside. It's like if you look at the total budget of your car, actually the insurance part of it is very significant, and the profitability on like a captive insurance business like that should be at least the same in terms of EBIT margin as a car business. So if they do 15% margin in cars, they should be doing at least that in the insurance business. Then you have autopilot. So we have done a lot of research on autopilot. We are very bullish autopilot, but we don't think this is something you can really buy today. It's going to take a few more, not that many more years, but a few more years. And of course, autopilot is an additional $6,000 to $9,000 of gross profit per car. So that's a massive game changer. I think the 25% gross margin could be 30% gross margin if autopilot
if
delivers.
the take rate goes up on
Exactly.
that. Yep.
But in order to believe in that, there are a lot of bits and pieces to come together. You need first to demonstrate, that's the same framework, that they have a unique product. So for now, they have the best product. Is it going to make progress faster than others to become a unique product? I want to say yes, but I need to do research. And I can't really prove that with research yet. Then the second one would be, what's the market for it? Is that going to appeal 10% of drivers or 90% of drivers? It's still too early to say. And then the profitability question is easy because it's 100% profit, at least gross profits. So we, over the next couple of years, in our research plans, we have to work on that. Is the product taking off and leaving competition behind? And is demand, how significant is demand? Once we have answers to that question, we will probably increase our expectations on how valuable Tesla is. That's the second one. And then there is one that is discussed a lot, on which Elon is also very vocal. This is a robotaxi fleet and stuff like that. That one we don't buy at all. We don't think driverless ride sharing on a standalone basis is something that is even possible. We think driverless is difficult, works only in very specific circumstances. So the way you can insert into a city driverless cars, which means without anybody behind the wheel, is through a very dense supervision system, and also a system that can pick for you eligible drives. So I might get a driverless car taking me from my home in the suburbs of New York to LaGuardia during out of peak hours, because that's a relatively easy ride. And you can imagine that the service, the company delivering the service will know very well my driveway, how to get out of my road, will know how to change highways, and will have a docking station at the airport. But now that will be 2% of my ride-sharing needs, and the rest of my needs need to be met by the same partner. So I think the only players who are able to actually introduce driverless ride-sharing are existing ride-sharing players. So Uber is actually the best positioned player in that field. Even if they don't have the technology, they'll get the technology from someone else. It's not a problem. They have the most important asset, which is liquidity, so that you can pick from a very large volume of ride opportunities the ones that are going to be eligible for driverless. And then the economic model of being number one in every city where they operate means that they have like the ability to make the investment and to slowly ramp driverless cars. And so that's not a technology issue. I'm not judging Tesla's ability to have a better system than Waymo. That I actually don't really care. What I'm judging is that whatever the technology, if you don't have the route to market, it's useless. And nobody has a route to market but ride-sharing players.
So essentially, because driverless ride-sharing would be supply limited and constrained by routes, you're saying that the demand for such a service would be sort of too low, and you kind of run into like that chicken and egg situation where
exactly
there's not enough riders because it doesn't meet their needs well enough, and there's not enough supply because maybe there's not enough.
Exactly.
The tech isn't good enough to handle all the situations where people need to use it.
Let's go through a very simple use case. Waymo deploys their cars in the suburbs of New York, like they did in Phoenix 15 months ago. So in order to cover properly people like me, they would need, let's say, maybe 15,000 cars. Okay, so that's a lot. And then they will need to educate me about, oh, Pierre, if you go to the airport off peak hours, take one of our cars. It's cooler and cheaper. Then I'll have to know that. How do they get that into my mind? It's very complicated. And then, when I pick up the car, I will have the alternative of Uber, and a ride from my home to the airport off peak with Uber is $50. So Waymo will have to be at least at $50, and probably if they want to win some business, they'll have to be significantly cheaper. You run the math. We did run the math for a city like Boston. Okay, we said it's going to be cash burn for 10 years with like a trough of cumulated cash burn of $7 billion just for one city.
Just to get to scale, basically?
Just to get to the scale, to like financing all these cars, financing cars with operators, supervision inside the car until you know you're safe enough to start removing the supervisor. It took Google a year to just start removing some supervisors in Phoenix, and it's still very, very small. You know, they have only 1,500 users in Phoenix. It's like they basically don't make money, and they are not going to make money for another probably 10 years if they keep going by themselves. So they'll have to partner. Now, what I'm assuming is that Waymo has a technological approach that is better fit to driverless than what Tesla is doing. So I'm assuming Waymo is going to be the first to partner with Uber. But who knows, maybe Tesla, because they have access to more data, they have like this shadow mode that maybe helps them. These things, it's difficult to call whether it's really going to be an advantage or not. I don't know at this stage. Maybe Tesla ends up having the best technology, but if one day you see Tesla doing driverless ride sharing, it will be part of Uber or Lyft, but not Tesla standalone.
Based on the idea that technologically they're not going to be able to cover the majority of routes you would need to cover,
yes,
right?
Exactly.
That's like the fundamental thesis of that.
Yeah, and so yes, exactly. You get it right, Rob. So that means if one day you can convince me that a Tesla can do any ride, then my whole thesis is wrong. Yeah.
What do you think the chances of that happening are? I know that's a really difficult thing to sort of even try to quantify or speculate on, but that's kind of what we have to do.
Yeah.
So what do you think that possibility is, and how has that possibility changed for you over time, if it has changed?
So here we come to really the very deep nature of what's called artificial intelligence, and what I actually named in my research artificial stupidity, because it's actually a very bad image. It's a very bad acronym, or a very bad framework to if you think, okay, AI does incredible things, that's true. AI systems now can do things better than humans, that's true. But the fact that they are intelligent, that these systems are intelligent, is actually not true. They don't think through things. They don't manipulate ideas. They are it's automated systems that have this self-learning capability. But you cannot call that intelligence. So I think like an automated system with self-learning capabilities cannot handle a general use case for driving. Because driving is actually 95% of the time very automated behavior when you steer your car and do stuff, make a left, put your signal, etc. But in the 5% of the time left, but 5% means, let's say, on a 20 minutes ride, it's going to happen once. Mm-hmm. Okay, so, or even actually you could argue on a 5 minutes ride, it's going to happen almost every ride, even if it's only 5% of the time. You're going to produce something that is so specific that we don't even have like the philosophical tools to qualify it, which is this form of human intelligence that is not general intelligence. General AI is another stupidity. It doesn't exist. Like there is no general intelligence. We are not generally intelligent. We are very intelligent at dealing with our lives and our bodies and our environment, but it's not general. But we have this capacity of being creative and finding solutions to problems that can't really be classified. So you're stuck behind a truck making a delivery. You have to drop off someone in a place where it's forbidden. You were expecting to have room in a street, but it's actually there is something happening that is different. You you get into a situation in which you need an eye contact to unlock a situation, like two cars coming together at a place where there is no clear cut on who has priority. How does like a computer do an eye contact? And these things are, where 1% of situations a year ago, they are now 0.1% of situations, and they're going to be next year 0.01% of driving situations, but they are still happening all the time. And because of that, driverless cars need to be very strictly supervised. So you need to limit the risk of that kind of incident. That wouldn't be like an incident killing anyone or hurting anyone, but that would just trigger like a mission failure. So it doesn't work.
Right.
Your car,
and then you're just kind of stuck in the middle.
Passes by the airport and keeps going because it couldn't get out of a lane. That's not acceptable. If it happens, can you imagine the resources you have to put in place to save a situation like that? You need to have the car parked someone go and pick up the client, and so you need these things to have a probability of happening that is almost zero, and still you will need to have the infrastructure to deal with that kind of situations, because even if it happens not very often, once you're at scale, it's going to happen every day in a city. And so that's all the things that make me think the problem is not technological. The problem is either philosophical, so you haven't convinced me that we understand what's that form of human intelligence of finding solutions to odd situations, driving situations, has not even been formalized. We don't even know how to describe how we do it. So if you can't describe it, you can't implement it on a computer. Because like deep learning is very easy to describe. You look at a lot of examples and you classify them, and before classifying them, you do like a deep decomposition of situations to be able to pull out very subtle classifications. These things we can explain them with very simple words. I can explain them to my mom if I want. But how I figure out the next move, let's say at least once every 5 minutes when I drive, I don't know how to describe how I do that. So there is no way someone can program that before I can describe it simply. And so that's my problem. So that's an interest of mine. We spend some time monitoring research in that field, and you have people who are working very hard at it and making some progress, but I think these are things that are still not anywhere, I would say. And so as long as I don't see progress on that field, I don't think there is a risk of like having like a real driverless general use case car.
Right. So autonomy, basically as it relates to where it falls into your price structure or your price target, is essentially additive to gross margin at this point. And then maybe some upside if something like this were to occur.
Yes, exactly. Exactly. I make a fundamental difference between driverless and autopilot. And I think autopilot is like, it can double your profit per car, so that's a lot.
Yeah.
And driverless, that's not a Tesla game.
Okay. Let's shift gears a little bit to competition, and I know you definitely touched on this in terms of thinking that there's not a lot of it for the electric vehicle space. Let's talk a little bit more about that. Who do you see as maybe best positioned to be most competitive, if anybody?
So what do you need to compete against Tesla? You need to be able to catch up with them rapidly on the technology. And to do that, you need to be very integrated. The reason why Nokia took 6 years to put out a bad competition to the iPhone is because Nokia was a very complex organization with a lot of suppliers, and while one guy was figuring out what type of touchscreen you need, the other guy developing the software was late adapting the software to the touchscreen. And then once these two guys had synced up, so we're talking already 2-3 years, the guys doing the hardware didn't understand that if you have a touchscreen, a capacitive touchscreen on which you can move with your finger, and if you can't have like the screen moving exactly at the same pace as your finger, then the experience is broken. So you need like a GPU accelerating your new software. In a big organization, that kind of coordination doesn't exist. In a car, you have like 50 different MCUs, You have 300 sources of software, and a car being like a very mature object, the industry has done a very good job over the last 25 years at actually increasing the amount of subcontracting. You know, at some point when you know exactly what you want to do, people providing you parts end up being in a better position from below in order to optimize a subsystem. If you stop doing a wheel and you ask the guys doing the tires and the brakes that are combined in the same company to deal with the wheel and direction subsystems, they're going to do a much better job than you, as long as what a wheel and a direction subsystem is supposed to do is very, very standardized. And then when you have to completely change your product and its architecture, that becomes a very difficult constraint to deal with, that complexity. So companies that are best positioned to deal with that are simply, number one, companies who acknowledge the problem. So VW was the first one to do it amongst like the main car manufacturers. You hear now Daimler talking about it fairly vividly. In the last couple of years, you've seen, companies acquiring like startups in order to have that integrated model. But execution for all these guys is still going to be extremely, extremely difficult. It's like, I think Nokia had a good understanding of their problem a good 4 years before they pulled out a decent, but just decent, like competitor to the iPhone, and it was for them too late. So I think competition coming from that side of the industry is going to struggle a lot to adapt their model, to get more integrated. So you see VW, for instance, wants to ramp up the share of software that is developed internally. So they have a target of having 35% maybe of the software developed internally in 5 years from now. You're like,
it's not going to cut it.
Even if you have 95%, it's still crap because you actually have the 5% bit that is not good. But at least it's safe. They're going to get there. And then Daimler is saying, well, you'll see, we're going to develop a new platform with our own operating system. And you're like, oh my God, this is going to be difficult to reintegrate back into like what makes the strength of Daimler, which is their existing business. So it is very, very difficult. Then you have startups. What's their name? Rivian here. You have
you have Lucid, Byton,
and the ones in China that are probably the most advanced, like
Neo.
Mm-hmm. So all these guys have actually the chance to first be very nimble, very agile. Second, to have like a good like initial path, cleared by Tesla, so they know where to go. Now they'll have a problem is that they have way less experience than Tesla, and so they'll have to catch up on experience. Okay, so on one side you have people who have 100 years experience, but that's mostly irrelevant experience, and their challenge is transformation. And then you have fast followers whose challenge is going to be to be able to catch up with Tesla on speed. Everything Tesla does, they can do it as well. They're very good. And on top of that, they know where to go. And the difficulty for them is that Tesla remains extremely agile, extremely fast. So as long as Tesla delivers, I think it's very difficult for them to catch up.
Is this a situation where, like Nokia, there's sort of like a date where it happens where there's no coming back, and we see bankruptcies across the board, or what is your outlook, I guess, for the rest of the automotive market?
Yeah. So it's a good question. Remember that massive success for Tesla is 3 million units in 2025. So that means roughly 97 million units are still available to grab for others. So these players are going to have to invest a lot to catch up. Like when Nokia redesigned their operating system of a damn phone, they spent about $1 billion on that. So it's going to cost them, and when you look at the budgets announced by VW and others for their electric platforms, it's several billions of dollars. So I think they'll have to spend a lot of money to adapt, and I think it's going to be very painful. But are we going to see bankruptcies and things like that, like Nokia? I think like the product cycle of mobile phones was very fast. Mobile phone was a very, very heavily concentrated market already, and so the route to disappearing was actually fairly straight. In the car industry, you have like a very fragmented market. Manufacturing is more challenging. It's a much more diversified and fragmented demand as well. You have a lot of different types of cars. Electric is not going to take over the car market in 10 years. It's going to take much longer to get to like a near 100% type of penetration. And Tesla is not going to be able to meet all demand anyway. And actually, the world's industry is not going to be able to ramp the large-scale manufacturing of batteries fast enough for electric to take over the car industry over the next 10 years. So things are going to move very slowly. So I wouldn't worry too much about bankruptcies on the side of large players, but I wouldn't be surprised if they don't make a dime over the next decade in terms of profits. Then on the side of smaller competitors, we were doing some work on electric trucks recently, and it's interesting to see that there are niches where you can actually differentiate with a certain category of product, where your lack of scale against Tesla is not an issue, where you have the opportunity to create a differentiated brand, and you will probably get financing support from the traditional industry, the way Rivian has been acquired by a traditional player for a long time. So I think these brands will probably thrive, and they're probably not going to make a lot of money, so I wouldn't recommend them to investors, but I think they could do actually relatively well. And remember not early days, but like phase 2 or phase 3 of the auto industry. So phase 1, automotives were almost like handcrafted products. Then phase 2, Tom Ford realized you could actually standardize the product and manufacture it very efficiently with new manufacturing techniques. And then phase 3 was the car becomes a mass market product, and at that point in time you had like hundreds of brands everywhere in the country. And so I'm kind of wondering if like the premium auto market doesn't end up like that. So you have first like a phase of very heavy fragmentation and then some form of reconsolidation. But here we're talking things that happen over 10 to 15 years.
Got it. And then probably the last question, I think we're getting close on time. What do you view as the biggest risks for Tesla?
So I think it's execution. Because as long as they execute like in line with their execution capability, the execution capabilities that they've demonstrated so far, there is no like left corner, like new, better. Even if VW, who are probably the most active on the electric front, executes smoothly and perfectly, that means VW will be saved in 5 years. But they're not going to slow Tesla basically. So as long as they execute, all of their risks are fairly theoretical. So that would be risk number 1. And maybe risk number 2 is actually demand. Because when you say, well, in the US, the Model 3 is selling in such a way that if you extrapolate that to the rest of the world and forever, it's going to represent 20 million units a year. But when you're extrapolating to the rest of the world and forever, you're making two very big implicit assumptions. That what happened for the Model 3 is replicable, is universal, it's part of human nature. That's a big assumption. And the bear case last year was, no, like the 200,000 guys who bought a Model 3 are weirdos. They are the same guys on Twitter who love the stock. They are weirdos. We institutional investors think this market doesn't exist.
Right.
And they bet billions of dollars on that. It was a bad bet, obviously, but it wasn't an insensible bet. So you have to keep an eye on end demand and make sure that it continues to be there. So the need for a Tesla is anthropological. It's part of human nature. That's embedded into any bull case on Tesla. So you have to keep an eye on it.
Right, for sure. All right, I think that's time then. Thanks, Pierre. Really appreciate you coming on. It's a good conversation.
Nice to be here. Thanks a lot for giving me the opportunity.
Yeah, absolutely. Anytime.
Cool.